All right, we've got another case study for you. This time we're looking at an NPL JR that was paid. So NPL, in this case, non-performing loan, JR for a junior position lien, so we need to make sure we understand what's happening with the senior in front of us, and paid. This was a full payoff that was the conclusion of a modification agreement. So in this case, we were secured by an SFR, or a single family residential property. The senior lien was current, great news, and we have full equity coverage protecting our lien. Now, our SFR FMV, or the value of the property securing our investment, was $433,000. So to calculate the equity, we subtract the senior lien balance of $315,000, leaving us $118,000 of equity. Now, if our junior position UPB was more than $118,000, it may be partial or no equity. But in this case, the unpaid principal balance on the junior was $37,219. So if we take the senior, the fair market value minus the senior to calculate that $118,000 of equity, and then we divide the UPB, then we get 3.19, which means we've got full equity coverage. If it's greater than 1, it means that there is enough equity in the property to cover the junior lien. But this doesn't account for the borrower's position financially. For that, we need to look at the CLTV, or the combined loan to value. And this calculation is done by taking the first lien balance plus the second lien balance divided by the fair market value. And if it's less than 100%, then it is a full equity coverage, and in this case, 81.21% CLTV, or combined loan to value. So now let's look at the next step of the process here, which is exactly what happened. We bought the loan for $19,900, which represented a purchase price of 53.47% of the UPB. And we ended up getting a modification done on this deal of $362 per month. Now, if you just take the monthly payment and annualize it by multiplying it by 12, divided by what we paid, the cost basis, you can get a back of the envelope calculation of a 21.83% annual return. Now, this is very rough calculation. It doesn't account for the $20, $25 per month monthly servicing fee on the loan. And it also doesn't account, on the positive side, for the $1,000 down payment that this borrower made on the deal before starting that $360 per month payment. So what we really need to do is calculate the internal rate of return to know for sure what our return was on this deal. But before we get into that, let's talk about this borrower's story. So this particular borrower, when we first spoke, was kind of in a flurry of activity. I could hear his daughter in the background. They seemed to be at the grocery store. There was a lot going on, but he was happy for the call and wanted to talk further. So the next day, when he had some time, he gave us a call back and we started discussing the account. We learned that they were a small business owner and they were through some rough times, but it seemed like they were out the other end and ready to start a modification agreement on the loan to get back on track. So we were able to negotiate $1,000 down plus $362 per month and an 8.75% interest rate. That modification agreement was only paid for 4 or 5 months before they refinanced the loan and paid us off in full. So when we look at that whole situation through the lens of an internal rate of return, we can really get to see what our actual return was on the deal. So first, let's take the total of the monthly payments plus the payoff, and then deduct the cost basis on the deal and divide by the cost basis on the deal. That's a pretty simple calculation for the return on investment. But what it leaves out is the time consideration, and that's what the denominator of this calculation is. The months it took to exit the deal divided by 12 months in a year to determine how much you actually made when you look at it from that time value of money perspective. So let's plug in those numbers. We earned $38,711 when we took all the monthly payments plus the lump sum payoff at the 5th month. And then we deduct $19,900 and divide by $19,900, making sure to use PEMDAS, use those parentheses so you can do the order of operations here, divided by the 8 months it took to go from purchasing the loan, resolving it, collecting a couple monthly payments, and then paying off the loan. So when you run those formulas out, you can see that 94.5% is the ROI. And if it was done in 1 year, that would be the true ROI. But when we take 8 divided by 12, we can see that it took 0.667 of a year. So when we take the ROI of 94.5 divided by that 6.667, we can see that we earned a 142% internal rate of return on this deal. So let's dig into the last step here, which is the takeaways. What do we learn from this particular investment? So a few things here. The first is to show the borrower a per diem rate. When you're getting a modification agreement started or you're waiting for a payoff, a lump sum payoff, you want to run a payoff quote with your loan servicer that shows the per diem or per day amount that balance will increase with each passing day that goes by past the payoff date. Now, in the beginning, this for a modification agreement, this is really important so you can show the borrower that there is a time consideration here. The faster they can agree to the terms that you've set in place and without those terms expiring, the better of a deal they're going to get. In this case, the borrower did miss the first deadline. We had already negotiated the terms for the modification and they failed to sign the docs and submit their down payment. So when we show them that, well, at this point, those terms may no longer be available to you and the payoff balance on the loan has increased, it gives us a little bit more of a better relationship when we're able to extend the original terms and start off on the right foot. Dealing with your borrowers in good faith like this can make a huge difference with the longevity and the consistency of those monthly payments going forward. So I always like to show the borrower the worst case scenarios, show the borrower what we as the lender are authorized to collect or to pursue, and then give them a little bit of grace. It builds a lot of good faith and can start your modification agreement on the right foot. The next takeaway here is to make sure you set your interest rate in a way that gives the borrower an advantage to refinance. Back when this particular deal was done, the modification agreement was written at 8.75%. So when the borrower refinanced in early 2021, the interest rates were much better and he was able to save some money on his monthly payment and the total interest that he was going to pay throughout the course of that loan. Today, in Q2 of 2023, prime is the rate that a lot of banks set their interest rates on is 8%. So a lot of loans are prime plus 5% or so. So that's 13% interest rates. That's a huge amount that you actually need to, as a note investor, incorporate into your modification agreements. I'm not saying to write them at 13%, but to make sure that the interest rates that you offer on your modifications as a private note investment company are more than they would get from an institutional lender. This allows them to save some money by refinancing the loans. It aligns your interests. And finally, one last takeaway, another way to align your interests is to make sure that you do not charge a prepayment penalty. Prepayment penalties are pretty common, especially with interest-only loans, because it allows the bank to collect all those monthly interest payments. And if the borrower wants to pay off the loan early, they have to pay for that. Now, we never charge prepayment penalties because we want our borrowers to pay off the loans early. So by combining the higher interest rate with the no prepayment penalty, we can align our interests and encourage the borrower to get that loan paid off. And that's our perspective because we want to recapitalize and then use that investment to buy more mortgage notes. So that's it for today's case study, an NPL JR that was paid off through a completion of a modification agreement. And tune in next time for our next case study.